There is a lie that has been sold to you, a quiet and persistent poison dripped into the consciousness of every investor, every entrepreneur, every person who dreams of achieving financial freedom. The lie is that wealth is born from excitement, that fortunes are forged in the fiery crucible of innovation, on the bleeding edge of technology, in the industries that dominate the headlines and capture the imagination of the world. We are told to find the next Amazon, the next Tesla, the next great disruptor that will change the fabric of our lives. We are taught to equate the new with the profitable, the complex with the valuable, the revolutionary with the rewarding. And so, the 99% of market participants spend their lives on a frantic, exhausting treadmill, chasing ghosts. They chase algorithmic trading schemes, they chase biotech companies with miracle cures that are perpetually 5 years away, they chase electric vehicle startups burning billions in venture capital. They are moths drawn to a flame, and just like the moth, they are almost always incinerated. Warren Buffett, the man who has compounded wealth on a scale that beggars belief, has built his 9-figure-a-day empire on the foundation of a single, profound, and deeply counterintuitive truth. He has become one of the richest men in human history by systematically and ruthlessly ignoring the very things we are told to pursue. He ignores the headlines. He scoffs at the complex. He runs from the revolutionary. Because Warren Buffett understands the truth that is hidden in plain sight. Excitement is the enemy of profit. The greatest and most durable fortunes are not built in the glittering city of innovation. They are built in the quiet, dusty, forgotten farmlands of boredom. They are built on businesses so mundane, so predictable, so utterly unexciting, that the MBA graduates and the Wall Street analysts simply overlook them. This is the great secret. The real money, the kind of life-altering wealth that endures for generations, is made where no one else is looking. It's made in garbage collection, in railroads, in bricks, in paint, in insurance, in chewing gum, and in sugary soft drinks. Today we are not going to learn a simple stock-picking tip. We are going to perform a complete rewiring of your financial brain. We are going to surgically remove the instinct that tells you to chase excitement and replace it with a cold, rational, and immensely powerful framework for seeing the world as Buffett does. We will deconstruct his single greatest principle, that a business constantly in the headlines is a financial trap, while a boring, predictable business is a wealth generation machine. This journey is divided into 5 parts. First, we will explore the tyranny of the new, and why the siren song of innovation so often leads to financial ruin. Second, we will build the fortress of predictability, understanding the immense power of a business that never, ever changes. Third, we will uncover the toll booth imperative, learning to identify the unsexy monopolies that silently tax the economy. Fourth, we will master the price of certainty, discovering how to value these boring businesses with a precision that is impossible in the world of tech. And finally, we will assemble the compounding machine, learning how to construct a portfolio of these quiet giants that will work for you, day and night, for the rest of your life. By the end of this journey, you will no longer see a can of Coca-Cola or a freight train rumbling past as simple objects. You will see them for what they are, artifacts of a wealth creation philosophy so powerful it has reshaped the global economy. You will learn to love the boring, and in doing so, you will find the key to your own financial transformation. Let us begin with the first pillar, the tyranny of the new, and why excitement is the single most dangerous emotion an investor can feel. To understand this, we must travel back to 1989. The world was on the cusp of a technological revolution. The personal computer was entering the home, the internet was a nascent dream, but the technology that had truly captured the imagination and wallets of investors for decades was flight. The airline industry was a symbol of human ingenuity, a marvel of engineering that had shrunk the globe. It was exciting, it was innovative. It was constantly in the headlines with new planes, new routes, and new promises of a connected future. And in 1989, Warren Buffett, despite his better judgment, got sucked in. He invested a staggering $358 million into preferred stock of US Air. On the surface, it might have seemed like a classic Buffett move. Airlines were a critical part of the American economic infrastructure. But Buffett was not investing in the infrastructure. He was investing in the service that used it, and that was his fatal mistake. From the moment the ink was dry on the deal, it was a nightmare. The airline industry, for all its technological glamour, was what Buffett would later call a death trap for capitalists. The competition was absolutely brutal. Deregulation in the late 1970s had unleashed a torrent of new carriers, all fighting tooth and nail for the same customers. This led to vicious, unending price wars. Every time one airline tried to raise its fares to a profitable level, a competitor would slash theirs to gain market share, forcing everyone back down into the gutter of razor-thin or non-existent margins. The business was also fantastically capital-intensive. A single new airplane cost a fortune, and fleets constantly needed to be updated. This meant that even in the rare good years, most of the cash generated had to be plowed right back into buying new equipment, leaving nothing for the owners of the business. Then there were the unions. The powerful pilot, mechanic, and flight attendant unions held the airlines hostage, demanding enormous salaries and benefits that consumed a huge portion of revenues. And finally, the business was acutely sensitive to things completely outside its control, like the price of jet fuel. A spike in oil prices could wipe out an entire year's profit in a matter of weeks. Buffett watched in horror as his investment soured. The dividends he was promised were suspended. The stock price of US Air plummeted. He was trapped in a business that was a black hole for capital. It was an industry that, as he famously quipped, had not made a single dollar of cumulative profit since the Wright brothers first took flight at Kitty Hawk. Think about that. An entire industry, one of the most technologically significant of the 20th century, had created zero aggregate value for its shareholders over its entire history. It was a perfect illusion, a business that looked impressive, modern, and essential, but that was economically structured to destroy the money invested in it. Buffett's experience with US Air was a painful, multi-million-dollar lesson that he seared into his brain. He eventually got his money back, largely due to a market upswing, but the experience was formative. He learned that the most exciting, innovative, and rapidly changing industries are often the very worst places to put your money. The constant change, the intense competition, the endless need for new capital, these are not features of a great investment. They are the hallmarks of a financial quagmire. The lesson was clear. Innovation and investment returns are not correlated. In fact, they are often negatively correlated. The reason so many of us fall into the same trap that ensnared Buffett in the airline industry is rooted deep in the wiring of our brains. The core psychological principle at play is known as the availability heuristic. This is a mental shortcut where we judge the likelihood of an event based on how easily examples of it come to mind. The media does not report on the slow, steady, predictable earnings of a company that makes wall paint. That's boring. It's not a story. But a company that announces a breakthrough in artificial intelligence, a new electric vehicle with 1,000 horsepower, or a revolutionary software platform, that gets plastered on the front page of every financial publication. It's available, it's salient, it's emotionally resonant. Because these stories are so readily available to our minds, we vastly overestimate their importance and their probability of success. We see the headline about a new technology, and our brain immediately concludes, this is the future. I need to be a part of this. We mistake the visibility of the innovation for the viability of the business. This is compounded by another powerful cognitive bias, the fear of missing out, or FOMO. When we see stories of early investors in a hot tech stock becoming millionaires overnight, it triggers a primal fear that we are being left behind. The train to financial freedom is leaving the station, and if we don't jump on board right now, we'll be stuck on the platform forever. This emotional response short-circuits our rational brain. We stop asking critical questions about profitability, competition, or valuation. The only question that matters is, how do I get in? This creates a feedback loop. FOMO drives retail investor money into a hot sector, which pushes stock prices up, which generates more breathless media headlines, which in turn creates even more FOMO. It's a psychological vortex that inevitably ends with the latecomers, the 99%, buying in at the absolute peak of the hype, just before the economic reality of the business sets in, and the stock comes crashing back to earth. Buffett's genius lies in his ability to completely immunize himself from this process. When he sees a frenzy of media attention around an industry, he doesn't feel the fear of missing out. He feels the urge to run in the opposite direction because he knows that the crowd is almost always wrong. So how can we, as retail investors or entrepreneurs, apply this principle in a practical way? The mental model to install in your brain is what I call the newspaper test. It's a simple, powerful filter to protect you from the tyranny of excitement. The next time you feel tempted to invest in a company that everyone is talking about, put it through this three-part test. First, gather all the recent articles and news reports about the company. Now take a highlighter and mark in green every sentence that talks about the company's technology, its innovation, its potential to change the world, or its visionary founder. Then take a red highlighter and mark every sentence that talks about the company's current profits, its free cash flow, its profit margins, and its return on tangible capital. Now step back and look at the page. If the page is a sea of green with only a tiny speck of red, a massive warning siren should be going off in your head. You are not reading about a business, you are reading a science fiction story. The narrative is focused on the promise of the future, not the reality of the present. Second, in those same articles, count how many direct competitors are mentioned who are also racing to do the exact same thing. In a story about a revolutionary new industry, you will almost never see just one company mentioned. You will see a dozen, all backed by venture capital, all fighting for the same prize. This is a critical red flag. As Buffett learned with the airlines, fierce competition is the killer of profits. The more companies are chasing the same dream, the less likely it is that any of them will ever make a significant return for shareholders. A truly great business dominates its field. It doesn't just participate in a battle royale. Finally, and most importantly, try to explain in a single, simple sentence how this company will be making predictable, growing profits 10 years from now. If your explanation requires a string of buzzwords like synergy, paradigm shift, network effects, or capturing the total addressable market, you have failed the test. You should be able to say something like, in 10 years people will still be drinking Coca-Cola, and the company will sell it to them for a little bit more than it does today. If you cannot articulate the path to profitability with that level of simple clarity, it means the future is unknowable. And if the future is unknowable, you are not investing, you are gambling. By systematically applying the newspaper test, you create a rational buffer between the market's hype and your investment decisions. You train yourself to see headlines not as a call to action but as a signal of danger. You begin to build the psychological armor that is the first step towards true wealth management. To truly appreciate the wisdom of this approach, we must spend a moment walking the path of the 99%, the path that actively rejects this principle. This is the path of chasing the next big thing, and its landscape is littered with financial ruin. The most potent example in modern history is the dot-com bubble of the late 1990s. The story was intoxicating. The internet was going to change everything. New companies with .com at the end of their names were popping up daily, promising to revolutionize every industry from pet food to grocery delivery. The media fanned the flames, celebrating newly minted 25-year-old billionaires. It was the ultimate siren song of easy money. Imagine a typical retail investor in 1999. Let's call him Dave. Dave is a smart guy, an engineer, but his portfolio is languishing in boring blue-chip stocks. Every day he goes to work and hears his colleagues bragging about the fortunes they're making on stocks like Pets.com or Webvan. These companies had no profits. They had no clear business model. But they had a story. Pets.com was going to revolutionize how people buy pet supplies. Webvan was going to deliver groceries to your door. The stock prices were doubling every few weeks. Dave feels the FOMO gnawing at him. He finally cracks. He sells his boring, profitable stocks and plows his life savings into these exciting .com darlings. For a few months, he feels like a genius. His portfolio soars. He feels the thrill, the excitement, the certainty that he has caught the wave of the future. He is on the path to financial freedom. Then, in March of 2000, the bubble burst. The market woke up and realized that these exciting stories were just that, stories. Without profits, without a sustainable business model, a company is worthless. Pets.com, despite its famous sock puppet mascot and Super Bowl ads, went bankrupt in November 2000, less than a year after its IPO. Its stock went to zero. Webvan, which had burned through over $1 billion in investor capital building state-of-the-art warehouses, went bankrupt in 2001. Its stock went to zero. Dave, our hypothetical investor, lost everything. His dream of financial freedom was obliterated, and he wasn't alone. Trillions of dollars of shareholder wealth were wiped out. This wasn't a failure of capitalism, it was a failure of psychology. It was millions of people choosing an exciting story over a boring balance sheet. This pattern repeats itself in every market cycle. In the 2000s, it was housing and financial innovation. In the 2010s, it was cannabis stocks or 3D printing. More recently, it was the bubble and speculative EV companies and unprofitable software-as-a-service stocks. The technology changes, but the psychological trap remains the same. The path of the 99% is paved with the corpses of exciting ideas that never became profitable businesses. The final piece of this pillar is to understand how this choice between excitement and boredom manifests directly on the financial statements of a company. This is where the theory becomes cold, hard numbers. An exciting, innovative company in a competitive field is on what's known as the Red Queen's treadmill. This refers to the character in Through the Looking Glass, who has to run as fast as she can just to stay in the same place. A tech company, for example, has to spend a massive portion of its revenue on research and development, R&D, just to keep up with its competitors. If they don't invent the next feature or the next product, they will become obsolete. This R&D spending is a direct hit to the bottom line. It's money that cannot be returned to shareholders. Similarly, they have to spend enormous sums on sales and marketing to convince customers that their new product is better than the nearly identical new product from their competitor. This is another massive drain on profitability. Now contrast this with a boring company like a candy manufacturer. Let's use See's Candies, a Buffett favorite. See's doesn't have a multi-billion-dollar R&D budget. The recipe for their peanut brittle hasn't changed in 50 years. They don't need to reinvent candy every year. Their capital expenditure is minimal, maybe a new cooking vat here, a new delivery truck there. Because they don't have to pour all their money back into the business just to survive, they generate immense amounts of what investors call free cash flow. This is the cash that is left over after all expenses and investments have been paid. This is the owner's cash. And this cash can be used to pay dividends directly into an investor's brokerage account, or it can be used to buy back its own stock, which makes each remaining share more valuable. The financial connection is direct and powerful. Exciting companies consume cash, boring companies produce cash. A portfolio filled with cash consumers is a portfolio on its way to zero. A portfolio filled with cash producers is a portfolio on its way to financial freedom. By choosing boredom over excitement, you are making a conscious decision to align yourself with businesses that are designed to enrich their owners, not just to generate headlines. This is the first and most critical step in rewiring your brain to invest like Buffett. Having understood the dangers of excitement, we can now turn to its powerful and profitable antidote, predictability. This brings us to our second pillar, the fortress of predictability, and the immense, often hidden power of an unchanging business landscape. If innovation and creative destruction are the enemies of capital, then stasis and monotony are its greatest allies. The ideal business from a Buffett perspective is one that will look almost identical 10 years from now as it does today. This predictability is the bedrock upon which a true investment thesis can be built, insulating it from the chaotic whims of technological change and market fads. And there is no better story to illustrate this principle than Buffett's 1972 acquisition of See's Candies. In the early 1970s, Buffett and his partner, Charlie Munger, were still honing their investment philosophy. They had made their early money buying cigar butt companies, terrible businesses at dirt-cheap prices. But Munger was pushing Buffett to evolve, to start buying wonderful businesses at fair prices. Then, a company called See's Candies came up for sale. On the surface, it was the epitome of boring. It was a family-owned boxed chocolate company based in California. Its products hadn't changed in decades. There was no revolutionary technology, no disruptive business model. It was just candy. The asking price was $30 million. Buffett, still anchored to his cigar butt roots, thought this was too high. He analyzed the company's tangible assets, its factories, its inventory, its delivery trucks, and calculated they were only worth about $8 million. He was only willing to offer $20 million. The See family, represented by their investment banker, refused. This is where Charlie Munger made one of his most important contributions to investment history. He told Buffett, in essence, to stop being so cheap. He argued that they were missing the most valuable asset the company possessed, an asset that didn't appear on the balance sheet: its brand. See's Candies had spent 50 years building a reputation for quality and nostalgia in the minds of its customers. In California, giving a box of See's chocolates for Valentine's Day or Christmas was a tradition. People associated the brand with happy memories, with family, with quality. This powerful emotional connection, Munger argued, gave the company a moat, a durable competitive advantage. It allowed See's to charge a premium price for its chocolates, and customers would happily pay it because they weren't just buying candy, they were buying a trusted, beloved product. Munger convinced Buffett that this intangible asset was worth paying for. They went back to the sellers and agreed on a price of $25 million. The decision to buy See's Candies fundamentally changed Berkshire Hathaway and the world of investing. It was Buffett's first major purchase of a quality brand, and the results were nothing short of miraculous. That boring candy company, purchased for $25 million, has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway. And crucially, it did so while requiring very little additional capital investment. The brand, the moat, did all the heavy lifting. Because the product never changed, they didn't need to constantly retool factories or spend fortunes on R&D. Because the brand was so strong, they could raise their prices a little bit each year to counteract inflation, and their loyal customers wouldn't bat an eye. See's Candies became a gusher of cash that Buffett could then use to go and buy other wonderful, predictable businesses. It was the perfect case study. A completely boring, static industry allowed for the creation of a powerful, enduring brand that translated into decades of predictable, high-return profits. It taught Buffett and Munger that the future doesn't have to be exciting to be incredibly lucrative. In fact, it's better if it's not. The psychological principle that makes a business like See's Candies so powerful is a concept known as ambiguity aversion. Humans have a natural tendency to prefer known risks over unknown risks. We would rather choose an option with a 50% chance of success that we understand than an option with a potentially higher but unknown probability of success. Buffett applies this directly to his investment strategy. When he looks at a business like Coca-Cola or See's Candies, the risks are known and quantifiable. What's the risk for Coca-Cola? Maybe the price of sugar goes up, or consumer tastes slowly shift towards healthier drinks. These are understandable, analyzable risks. Now, what are the risks for a cutting-edge gene-editing company? The risks are a complete mystery. Will their technology work? Will it get regulatory approval? Will a competitor invent a better technology tomorrow? Will the public accept it? These are not risks, they are ambiguities. They are unknowable unknowns. By focusing on boring, predictable businesses, Buffett is systematically avoiding ambiguity. He is choosing to play a game where the rules are clear and the odds can be calculated, rather than a game shrouded in fog. This connects to another bias, the endowment effect. This is our tendency to value something more highly simply because we own it. See's Candies masterfully leverages this on a brand level. For a family that has been buying See's chocolates for 3 generations, the brand is not just a product choice, it's part of their identity. They feel a sense of ownership over the tradition. This creates an incredibly sticky customer base and immense pricing power. They are not just selling chocolate, they are selling nostalgia and reliability. This is a fortress that is almost impossible for a new competitor to assail. A startup can create a new chocolate, but it cannot create 50 years of happy Christmas memories. The unchanging nature of the product and the industry is precisely what allows this powerful psychological moat to be built, brick by brick, over decades. To operationalize this search for predictability, we can use a mental model called the 10-year test. This is a profound yet simple exercise to perform before making any long-term investment. The task is to sit down with a blank piece of paper and write a detailed paragraph describing what you believe the company and its industry will look like in 10 years. The key is to be brutally honest about the level of certainty in your predictions. Let's apply the test to 2 hypothetical companies. First, a boring one, the Hershey Company. What will Hershey look like in 10 years? It's highly probable that they will still be the dominant seller of chocolate bars in North America. Their core products, the Hershey bar, Reese's peanut butter cups, Kisses, will almost certainly still be on store shelves everywhere. The primary drivers of demand, people's desire for a simple, affordable sweet treat, will not have changed. Their main competitors, Mars and Nestle, will still be their main competitors. They will likely be selling slightly more product at a slightly higher price. You can write this paragraph with a very high degree of confidence. Hershey passes the 10-year test with flying colors. Now let's try a more exciting company, a startup that makes delivery drones. What will this company look like in 10 years? The uncertainty is staggering. Will drone delivery even be legal on a mass scale? What will the regulatory framework look like? Which technology standard will win out? Drones, ground-based robots, or something else entirely? How many giant competitors, from Amazon to Google to FedEx, will be in this space? Will the company's current battery technology be obsolete in 3 years? It is impossible to write a paragraph about this company's future with any degree of confidence. Your description would be pure speculation, a guess layered on top of a hope. The company fails the 10-year test spectacularly. This mental model isn't about predicting the future with perfect accuracy. It's about delineating the predictable from the unpredictable. By forcing yourself to project a decade into the future, you immediately see which businesses stand on solid ground and which are built on shifting sands. Your goal as an investor is to exclusively traffic in the former. The antithesis to this approach, the path of the 99%, is to fall for the growth at any price fallacy. In a bull market, narrative replaces numbers. Investors become obsessed with top-line revenue growth and ignore the ugly details of profitability. The story goes that if a company can just grow its sales fast enough, the profits will magically appear someday in the future. This is the siren song that led to disasters like WeWork. The story was compelling. WeWork was a technology company revolutionizing the office. The revenue growth was astronomical. But it was a house of cards. Underneath the tech company branding was a fundamentally broken business model, signing long-term leases for office space and renting it out on a short-term basis. The company was burning billions of dollars, with no plausible path to ever becoming profitable. Yet it was valued at $47 billion at its peak. Investors who bought into the WeWork story were not applying the 10-year test. They were caught up in the excitement, the charismatic founder, and the hockey stick revenue charts. They valued the company not on its predictable future earnings, but on its exciting narrative. Contrast this with See's Candies. See's has very modest growth, but every single year, it produces a torrent of predictable high-margin profit. The growth at any price investor looks at See's and sees a boring, stagnant business. The Buffett-style investor looks at See's and sees a perfect, low-risk, cash-generating machine. The 99% chase the illusion of growth. The masters of capital pursue the reality of profit. The former leads to catastrophic losses when the narrative breaks. The latter leads to the steady, quiet compounding of wealth over a lifetime. The financial connection here is one of the most important concepts in all of investing. Discounted cash flow, or DCF. A DCF analysis is a method of valuing a company by estimating all of its future cash flows and then discounting them back to the present day to arrive at a single number for its intrinsic value. Now, a DCF model is only as good as the assumptions you put into it. It's like the old computer science adage, garbage in, garbage out. This is where the power of predictability becomes a massive financial advantage. If you are trying to do a DCF valuation on that drone delivery startup, what numbers are you going to plug in for its revenues and profit margins in year 7 or year 10? It is pure unadulterated guesswork. You might as well be using a Ouija board. The resulting valuation is meaningless, an illusion of precision that hides a foundation of complete speculation. Now, try to do a DCF valuation on a boring, predictable business, like a regulated utility or a company that owns a portfolio of consumer food brands. You can look at the last 20 years of their financial statements. You can see their stable profit margins, their slow but steady growth, their predictable capital expenditures. You can project their future cash flows with a relatively narrow and reasonable range of outcomes. Your inputs are not garbage. They are based on a long history of stability. This allows you to calculate a much more reliable estimate of the company's intrinsic value. This is the holy grail of value investing. It allows you to know, with a reasonable degree of certainty, what a business is actually worth. And once you know what it's worth, you can simply wait until the market offers it to you for a price that is significantly less. The predictability of a boring business is what transforms valuation from a speculative art into a disciplined science, giving you a quantifiable edge over almost everyone else. We have established that boring, predictable businesses are superior to exciting, innovative ones. But within the universe of boring businesses, there is an elite class, a group of companies so powerful and so profitable that they form the bedrock of the world's greatest fortunes. This brings us to our third pillar, the toll booth imperative. This is the principle of investing in unsexy, near monopolies that act as essential gateways for the economy. A toll booth is a beautiful business model. It requires little effort to operate, and everyone who wants to get from point A to point B has to pay you a small fee. The best businesses in the world are not selling a product. They are positioned as an indispensable toll booth on the highway of commerce. And no anecdote illustrates this better than Buffett's massive all-in bet on the Burlington Northern Santa Fe Railroad, BNSF. In the fall of 2009, the world was still reeling from the financial crisis. Confidence was at an all-time low. But Warren Buffett saw an opportunity to make the largest investment of his entire life. He announced that Berkshire Hathaway would be acquiring the entirety of BNSF, the second largest railroad in the United States, for a staggering $44 billion. Wall Street was stunned. Railroads in the 21st century? It seemed like a relic of a bygone era. It was the opposite of the exciting tech stocks like Apple and Google that were beginning to dominate the market. But Buffett saw something different. He saw the ultimate toll booth. He explained his logic with beautiful simplicity. A railroad is an essential artery of the American economy. It is the most efficient way to move massive quantities of goods, coal, grain, oil, consumer products, over long distances. Trucks can't compete on cost for that kind of freight. And critically, the railroad industry is a natural monopoly. Just think about the cost and regulatory hurdles involved in trying to build a new, competing transcontinental railroad today. It would be impossible. You would need to acquire thousands of miles of contiguous land, navigate a nightmare of environmental regulations, and spend hundreds of billions of dollars. It will never happen. This means that BNSF and its primary competitor, Union Pacific, have a duopoly on land-based freight in the western United States. They have an insurmountable competitive moat, not made of a brand like See's Candies, but of literal steel tracks and mountains of granite. Buffett knew that as long as the American economy grew over the long term, more goods would need to be moved, and BNSF would be there to take its toll. It was, as he put it, a bet on the economic future of the United States. It was a bet on a boring, indispensable, unreplicable piece of infrastructure. That bet has paid off handsomely. BNSF is now one of the crown jewels of the Berkshire Empire, generating billions in predictable profit year after year, a testament to the enduring power of the economic toll booth. The psychological principle that underpins the power of a toll booth business is our inherent status quo bias. We are creatures of habit. We resist change and prefer to keep things the way they are. On a grand economic scale, this means that companies and consumers will stick with the established default option unless there is a massive incentive to switch. No company shipping grain from North Dakota is going to undertake the monumental task of trying to find an alternative to the railroad. They will simply use the railroad that is there, pay the fee, and treat it as a fixed cost of doing business. This is a form of mental accounting, where we compartmentalize certain expenses as non-negotiable. Your monthly electricity bill, your water bill, the fees you pay to Visa or MasterCard every time you swipe your credit card. These are all examples of toll booth businesses benefiting from the status quo bias. Buffett actively seeks out businesses that transcend the status quo. He doesn't want to be the disruptor trying to change customer behavior. He wants to own the incumbent that everyone is already locked into using. This is a much easier and more profitable game to play. A new social media app has to spend billions on marketing to convince you to change your habits and switch from the platforms you already use. In contrast, the local waste management company doesn't have to convince you of anything. You generate trash, and they have the exclusive municipal contract to pick it up. They are the deeply entrenched, unsexy, and highly profitable status quo. To find these toll booth businesses for your own portfolio, you can employ a mental model I call the indispensability audit. It's a series of questions designed to separate the truly essential businesses from the merely popular ones. Question 1. If this company disappeared overnight, would society grind to a halt or be significantly harmed? If Visa and MasterCard's payment networks went down, global commerce would instantly freeze. If a new fashion e-commerce site disappeared, people would simply buy their clothes elsewhere. The difference in indispensability is staggering. Question 2. How difficult and expensive would it be for a well-funded new competitor to replicate this company's assets and network from scratch? To replicate BNSF's railroad tracks would cost hundreds of billions and be practically impossible. To replicate the business model of most software companies, while not easy, is certainly possible for a competitor with enough smart engineers and capital. You are looking for businesses with physical or regulatory moats that are nearly impossible to breach. Question 3. Does this company sell something that customers have to buy or something they want to buy? People want a new iPhone, but in a recession, they can delay that purchase. People have to have electricity in their homes. They will pay their utility bill no matter what the economy is doing. They have to dispose of their garbage. This distinction between discretionary and non-discretionary spending is crucial. The best toll booth businesses provide essential, non-discretionary services that have no viable substitutes. By running potential investments through the indispensability audit, you train your mind to look past the superficial growth stories and identify the deep, structural advantages that create enduring monopolies. The opposite of this strategy, the path of the 99%, is to be drawn into what business strategists call red oceans. A red ocean is an industry where competition is fierce, brutal, and bloody. Think of smartphones, streaming services, or the food delivery app market. In these industries, dozens of well-funded companies are locked in a life-or-death struggle for the same pool of customers. They are forced to compete on price, constantly slash margins, and spend astronomical sums on advertising just to stay relevant. The result is that almost no one makes a sustainable profit. The entire industry is a giant bonfire of investor capital. Billions of dollars have been incinerated by companies like Uber Eats and DoorDash in a desperate war for market share, a war that has produced staggering revenues but even more staggering losses. An entrepreneur or investor sees a huge market like food delivery and thinks, if I can just get a small piece of that pie, I'll be rich. They fail to see that the structure of the industry itself makes profitability almost impossible. Buffett avoids red oceans like the plague. He is looking for blue oceans, uncontested market spaces where the competition is minimal or non-existent. A railroad in the western U.S. is a blue ocean. The credit rating agency Moody's, which has a government-sanctioned oligopoly, is a blue ocean. These are boring industries, but they are calm, protected, and immensely profitable. The 99% chase the action in the red oceans, fighting for scraps. The masters of capital quietly sail the placid waters of the blue oceans, collecting their tolls. The ultimate financial manifestation of a toll booth business is a single, magical concept: pricing power. Pricing power is the ability of a company to raise its prices over time without losing significant business to a competitor. It is, in Buffett's own words, the single most important factor in evaluating a business. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 10%, then you've got a terrible business. Let's connect this to the numbers. A company with true pricing power, like a railroad or a pipeline or a dominant consumer brand, can increase its prices each year by at least the rate of inflation. This means that inflation, which erodes the value of most businesses and savings, actually helps a toll booth business. Their costs might go up with inflation, but they can pass those costs, and then some, directly on to their customers. This causes their profit margins to remain stable or even expand over time. Now consider a business in a brutally competitive red ocean industry, like a restaurant. If they try to raise their prices by 5%, their customers will simply walk across the street to their cheaper competitor. They have zero pricing power. They are forced to absorb rising costs, which relentlessly squeezes their profit margins until they disappear entirely. Pricing power is the engine that drives long-term growth in earnings per share. It's the secret sauce that allows a boring company to compound its intrinsic value year after year, decade after decade. When you invest in a company, you are not just buying its current earnings, you are buying all of its future earnings. By focusing exclusively on toll booth businesses with demonstrable pricing power, you ensure that the stream of future earnings you are buying is one that will grow, reliably and predictably, for a very long time. We have now identified the ideal investment, a boring, predictable toll booth-style business. But finding a great business is only half the battle. The other, equally important half, is buying it at the right price. This brings us to our fourth pillar, the price of certainty, and how to properly value a boring business to give yourself a massive edge. The greatest businesses in the world can be terrible investments if you pay too much for them. The goal is not just to buy quality, but to buy quality at a discount to its true worth, and the predictability of a boring business is what makes this calculation possible. The perfect anecdote to illustrate this is Buffett's masterstroke investment in American Express during the Salad Oil scandal of 1963. At the time, American Express was a wonderful, dominant business. It had two main pillars: its traveler's check business, which was a global standard, and its relatively new credit card business, which was a symbol of affluence. But there was a third, obscure division of the company, that specialized in warehousing. This division had issued receipts to a company called Allied Crude Vegetable Oil, certifying that it was holding a massive quantity of salad oil in its tanks as collateral for loans. The problem was, the salad oil didn't exist. The company's owner, a con man named Tino De Angelis, had filled the tanks mostly with water, with only a thin layer of oil floating on top. When the fraud was discovered, Allied Crude went bankrupt, and the banks that had loaned it money came knocking on American Express's door, demanding to be made whole. The potential liabilities were enormous, potentially exceeding the entire net worth of the company. Wall Street panicked. The story was terrifying. The headlines screamed of fraud and bankruptcy. The stock price of American Express was cut in half in a matter of months. The market's narrative was that the scandal would destroy the public's trust in the American Express brand, killing its core travelers' check and credit card businesses. Everyone was selling. But Warren Buffett, then a young, unknown fund manager in Omaha, did something different. He didn't read the headlines. He did the boring, methodical work of a detective. He knew the key question was not about the salad oil, but about the durability of the company's moat. Had the scandal truly damaged the brand in the eyes of its customers? So he went out into the field, he visited banks and asked tellers if people were still buying American Express travelers' checks. They were. He went to restaurants and hotels and asked if customers were still using their American Express cards. They were. He even took his friend to a steak dinner and paid with an American Express card, watching the waiter carefully to see if there was any hesitation. There wasn't. He talked to merchants and customers and competitors. His conclusion was decisive. The salad oil scandal, while a huge financial blow, had absolutely zero impact on the power of the American Express brand in the minds of the people who mattered, its users. The market was panicking over a temporary, fixable problem in a small division, and in its hysteria, it was offering him the chance to buy a truly wonderful, predictable, dominant business for a fraction of its real value. Buffett famously invested 40% of his partnership's capital into American Express stock. Within a few years, the stock had quintupled, and the investment became a cornerstone of his early fortune. He didn't predict the future. He simply analyzed the present more rationally than anyone else. The psychological forces that created the American Express opportunity are two of the most powerful and destructive biases in investing: loss aversion and herding. Loss aversion is the well-documented phenomenon that the pain of losing is psychologically about twice as powerful as the pleasure of an equivalent gain. When the salad oil news broke, investors were not rationally calculating the potential financial impact. They were feeling the visceral, terrifying fear of a total loss. This intense fear drove them to sell the stock at any price, just to make the pain stop. This individual panic then triggers the herding instinct. We are social creatures, and in times of uncertainty, we look to the crowd for cues on how to behave. When investors saw the stock plummeting and read the panicked headlines, they assumed everyone else must know something they didn't. So they sold too. The selling begets more selling, creating a downward spiral based entirely on fear and social proof, not on a rational analysis of the underlying business's value. Buffett's superpower is his almost inhuman ability to remain detached from the herd. When the herd is euphoric, he is fearful, and when the herd is terrified, as they were with American Express, he becomes greedy. He uses their emotionally driven mistakes as his entry point. He understood that the market was confusing a dramatic but temporary story with the permanent reality of the business. The mental model Buffett used to exploit this situation is the absolute cornerstone of his entire philosophy, the margin of safety. This concept, first taught by his mentor Benjamin Graham, is the secret to both preserving capital and generating extraordinary returns. It's a simple, three-step framework. Step 1 is to calculate the intrinsic value of a business. This is your best estimate of what the business is truly worth, based on its ability to generate cash in the future. As we've discussed, this calculation is far more reliable for a predictable, boring business than for a speculative one. For American Express, Buffett could confidently project the future earnings from the traveler's check and card businesses because he had established that the moat was intact. Step 2 is to simply observe the market price. The stock market gives you a quote on thousands of businesses every single day. Most of the time, this price is a reasonable reflection of the company's value. But sometimes, due to fear or greed, the market price becomes completely detached from the intrinsic value. This was the case with American Express in 1963. Its market price was reflecting a reality where the entire business was doomed. Step 3 is where the magic happens. You only buy when there is a massive gap between the market price and your calculated intrinsic value. You insist on buying $1 worth of assets for 60 cents or 50 cents or even less. That gap, that discount, is your margin of safety. It is the cushion that protects you if your valuation is a little off, or if the company hits an unexpected rough patch, or if you just get unlucky. It's the suspension bridge that allows you to cross the chasm of uncertainty. For American Express, Buffett calculated a conservative intrinsic value, and the market was offering him the stock for less than half that. He had an enormous margin of safety. This discipline, to value a business independently of its market price, and to only act when a significant margin of safety exists, is the single greatest protector against permanent capital loss. The 99% of investors do the exact opposite. They don't practice a margin of safety. They engage in what is called relative valuation and momentum chasing. They have no idea what a business is intrinsically worth. Instead, they justify a high price for one stock by comparing it to another, equally overpriced stock. During the dot-com bubble, an analyst would say, well, Company A is trading at 100 times its revenue, so Company B, which is in the same industry, is a bargain at 80 times its revenue. This is not valuation. It's a game of collective delusion. It is building a castle in the sky with no foundation in the reality of earnings and cash flow. They are not asking, what is this business worth? They are asking, what will someone else, a greater fool, pay me for this stock tomorrow? This is often combined with momentum chasing, simply buying a stock because its price has been going up. The rising price is seen as validation that it's a good investment, creating a self-reinforcing feedback loop that has nothing to do with the underlying business. This is the path of pure speculation. The margin of safety investor buys based on price relative to value. The momentum chaser buys based on price relative to recent price action. The former is a robust, business-like strategy for wealth creation. The latter is a fragile, psychological gamble that always ends in disaster when the momentum inevitably shifts. Let's drill down to the specific financial metrics that allow for a proper valuation and provide that price of certainty. Two key concepts are return on invested capital, ROIC, and Buffett's idea of owner earnings. ROIC measures how efficiently a company is using its capital to generate profits. A truly great business can invest $1 of capital and generate a consistently high return on it, say 15 or 20 cents of profit per year. Businesses in competitive, capital-intensive industries often have terrible ROIC. They have to invest billions just to eke out a tiny profit. A boring, dominant business like See's Candies, however, required very little new capital to grow, so its ROIC was and is astronomical. This leads to the concept of owner earnings. Buffett realized that standard accounting net income wasn't a true representation of a business's profitability from an owner's perspective. He defined owner earnings as net income plus non-cash charges like depreciation and amortization, minus the average annual amount of capital expenditures required to maintain the business's competitive position. This is the true cash flow that is available to the owners to either take out of the business or reinvest for growth. Boring businesses with low capital expenditure requirements are owner earnings machines. They gush cash. The financial advantage becomes crystal clear. The predictability of a boring business allows you to confidently estimate its future owner earnings. The margin of safety framework then instructs you to buy that stream of predictable, high-return cash flow for a cheap price. This isn't a get-rich-quick scheme. It is a systematic, rational process for purchasing future income at a discount. It is the engine of true long-term portfolio growth. We have come to the final pillar. We have learned to shun excitement, to embrace predictability, to identify economic toll booths, and to buy them only with a margin of safety. Now, we must assemble these individual components into a coherent, powerful whole. This brings us to our fifth and final pillar, the compounding machine, and how to build a portfolio of quiet giants that will create wealth for you automatically and inexorably. The ultimate case study for this principle is not a single investment, but the entire story of Berkshire Hathaway itself. It is the grand meta-narrative of how to assemble a collection of boring businesses into the most formidable wealth creation engine the world has ever seen. Berkshire Hathaway, as it exists today, was born from the ashes of a dying business. In the 1960s, it was a struggling textile mill in New England. The textile industry was a textbook example of a terrible business. It was brutally competitive, required constant capital investment in new looms, and faced relentless pressure from low-cost foreign producers. It was a red ocean nightmare. Buffett bought it because it was a cigar butt. It was trading for less than the value of its working capital. He thought he could squeeze one last puff of profit out of it. But he quickly realized that owning a terrible business, even at a cheap price, was a path to misery. The small cash flows the textile business did generate were a constant temptation to reinvest back into the failing operation, like throwing good money after bad. Then, Buffett had his epiphany. Instead of reinvesting the cash back into the dying textile business, what if he used that cash as seed capital to buy into wonderful, predictable businesses? In 1967, he used the meager profits from the textile mill to buy 2 insurance companies in Omaha, National Indemnity and National Fire and Marine Insurance. Insurance was a far better business. It was boring, it was predictable, and most importantly, it had a magical characteristic called float. Insurance companies collect premiums from customers up front and only pay out claims later. In the meantime, they get to hold and invest that money, the float, for their own benefit. Buffett had discovered a way to get paid to hold other people's money. He then took the ever-growing insurance float and, combining it with the profits from his other investments, began to systematically acquire whole or partial stakes in the exact kinds of businesses we have been discussing. The Washington Post, a media monopoly, See's Candies, a dominant brand, Coca-Cola, a global toll booth, BNSF Railway, an indispensable asset. The story of Berkshire Hathaway is the story of transforming the cash flow from a terrible business into a portfolio of wonderful ones, and then using the combined cash flow from that portfolio to buy even more wonderful businesses. It is a real-world demonstration of how a collection of boring, cash-gushing companies, when assembled together, creates a compounding machine of unimaginable power. The deep psychological reason why so few people are able to build a portfolio like this is a cognitive bias called hyperbolic discounting. This is our powerful, innate tendency to prefer smaller, more immediate rewards over larger, later rewards. We are wired for instant gratification. This is why people choose the thrill of a lottery ticket over the slow, steady certainty of a savings account. In investing, this manifests as a desire for action and quick wins. A retail investor would rather buy a speculative stock that might double in a month but is more likely to go to zero than a boring stock that is likely to grind out a 12% return year after year. The thought of that slow, boring 12% return doesn't trigger the same dopamine hit in the brain as the exciting story of a potential 10-bagger. They cannot stomach the perceived boredom of the slow path, even though the mathematics of compounding prove that the slow path leads to exponentially greater wealth over the long run. Buffett's entire career is a testament to his victory over hyperbolic discounting. He is willing to look incredibly patient, even lazy, for years at a time, in order to reap the massive rewards that come from letting his quiet giants compound uninterrupted. So how do we translate this into a practical blueprint for our own wealth management? The mental model is the sloth portfolio construction method. It is a strategy built on the virtues of patience, concentration, and inaction, the very opposite of what the financial industry preaches. The first step is to create a boring watch list. Spend your time not trading but researching. Your goal is to identify 20 to 30 publicly traded companies that meet the strict criteria we've established. They must be predictable, with strong moats, and run by competent management. They are your toll booths, your dominant brands, your indispensable utilities. You do the hard work of valuing each of them, determining a conservative estimate of their intrinsic worth. Step 2 is the hardest part. Patience becomes your primary weapon. You do nothing. You sit and watch your watch list. You wait for the chaotic, emotional, manic-depressive stock market to make a mistake. You wait for a general market panic, like the financial crisis of 2008 or the COVID crash of 2020. Or you wait for a company-specific piece of bad news that is temporary and solvable, like the American Express salad oil scandal. You wait for the market to offer you one of your wonderful businesses at a price that gives you a significant margin of safety. This might take months, it might take years. The sloth is patient. Step 3 is decisive action. When you get your price, you don't just dip a toe in, you make a significant, concentrated investment. The idea that diversification means owning hundreds of different stocks is a fallacy for the intelligent investor. As Buffett says, diversification is protection against ignorance. It makes very little sense if you know what you're doing. If you have done the work and have high conviction in a handful of wonderful businesses purchased at a discount, concentrating your capital in those ideas is the surest path to outsized returns. Step 4 is the simplest of all. Hold. The ideal holding period for a wonderful business is forever. You are not buying a stock ticker. You are buying a piece of a business. As long as the business remains wonderful, you let it work its magic. You let the earnings grow, the dividends get paid, and the power of compounding work uninterrupted for decades. The sloth portfolio is a monument to the power of calculated inaction. The path of the 99% is the polar opposite of this. They practice what Peter Lynch called diversification. They buy dozens or hundreds of different stocks, often through high-fee mutual funds, ensuring that they will achieve perfectly average results, minus the fees. They don't know what they own or why they own it. This is often combined with a constant portfolio churn. They are always trading, reacting to the latest news, listening to pundits on TV, trying to time the market's every wiggle. This constant activity gives them the illusion of control, but it is the single greatest enemy of long-term returns. Every time they sell a stock, they incur transaction costs. And, most devastatingly, if they have a gain, they have to pay capital gains taxes. This constant tax drag is a brutal, silent killer of portfolio growth. The hyperactive trader is like a gardener who keeps pulling up his carrots every day to see if they're growing. The sloth portfolio manager is like a farmer who plants a grove of oak trees and then has the patience to let them grow for 100 years. This brings us to the final, direct financial connection, the irrefutable mathematics of compounding and tax drag. Let's imagine two investors, each starting with $100,000. Investor A follows the sloth portfolio strategy. She buys a concentrated portfolio of wonderful, boring businesses and holds them for 30 years. Her portfolio compounds at a solid, but not spectacular, 12% per year. Because she never sells, she pays no capital gains taxes along the way. After 30 years, her initial $100,000, compounding at 12%, will have grown to just under $3 million. Now consider investor B, the hyperactive trader. He chases exciting stocks, trades frequently, and manages to achieve the same gross return of 12% per year. However, because he sells his winners each year to chase the next hot thing, he has to pay a 20% capital gains tax on his profits annually. This tax drag reduces his effective compounding rate from 12% to 9.6%. It doesn't seem like a huge difference. But over 30 years, the results are devastating. His $100,000, compounding at 9.6%, grows to only about $1.5 million. He has ended up with half the wealth of investor A, despite achieving the same gross returns, simply because he was unable to sit still. He fell for the lie of excitement, and the price he paid was half of his financial future. The financial freedom promised by the frantic day trader is a mirage. The real, durable, life-changing wealth is built slowly, quietly, and boringly, in a portfolio of businesses that you understand, that you buy at a fair price, and that you have the wisdom to hold for a lifetime. This is the final promise of Buffett's philosophy: love the boring, and it will make you rich. You have just invested a significant amount of your most valuable asset, your time, to fundamentally rewire your approach to building wealth. You haven't just learned a tactic, you have acquired a complete mental operating system, a master key to Warren Buffett's financial kingdom. You now possess the framework for seeing immense, durable wealth, where almost everyone else sees only soul-crushing boredom. You understand that excitement is a trap, that predictability is a fortress, that the best businesses are unsexy toll booths, and that the price you pay determines your return. This knowledge separates you from the 99% who are destined to chase headlines and gamble their capital away. But mastering the art of identifying what to buy is only the first half of the complete equation. The second, and arguably more critical piece of the puzzle, is mastering the psychology of when to buy. Buffett himself has said that the stock market is a manic depressive business partner, there to serve you, not to instruct you. To truly build a fortune, you need more than just a business analyst's toolkit. You need a psychologist's understanding of fear and greed. You must learn to harness the market's emotional insanity for your own gain. This requires an entirely different, yet perfectly complementary set of mental models. Models designed not just to analyze balance sheets, but to exploit the predictable irrationality of the crowd. That video that is now appearing on your screen is not just another piece of content, it is the other half of the map. It is the bridge from knowing what a great business is, to knowing when the world will offer it to you on a silver platter. It is the link that connects business analysis with behavioral finance, completing the circuit of the Buffett methodology. It's the toolkit for turning widespread market fear into your personal, generational opportunity. You have already proven that you are not an average thinker. You have demonstrated the discipline to go deep, to understand the fundamental principles that underpin real success. The average person, the person who will never achieve financial freedom, clicks away now. They are satisfied with a partial understanding. But the serious student, the future wealth builder, recognizes a crucial missing link when they see it. They know their mental arsenal is not yet complete. The choice is yours. Is this the end of a lesson or the continuation of your ascent? Complete the map. Arm yourself for the market's madness. Click that video.